Giorgio, welcome back to the show. Great to have you here on a Friday. What's the top thing on your mind right now, sir?
Top thing on my mind, I would say, is looking forward to the weekend. So happy Friday to you.
There we go. I'll take that.
Right after that, at number two, one thing we've been really thinking about a lot here is, does the market believe the Fed? And so I thought your discussion just about some of the economic data that we've been seeing today is very interesting, because when you look at the dot plots at the Fed, there still seems to be a number of Fed officials who don't see rates rising throughout 2023, and the market seems to be pushing that forward, right? And so I think that will be one of the more interesting dynamics to think about as we continue to see data like today, where you've seen some truly spectacular numbers out of the PMIs, some of the best numbers in almost a decade.
Mm-hmm. Giorgio, when we have these unique days like today where the stock market has these cyclical companies rallying and then tech alongside it, how important is it to see bonds calm in that environment, to your point, where the 10-year has been quite placid compared to the first couple months of the year? Is that the connective tissue in a market like today that allows everything to move higher together?
I think it does. You were talking a little bit about the performance in technology and how you are seeing it across the entire spectrum, both software companies and semiconductor businesses, which you pointed out. And semiconductors, even though they're part of tech, they do have a cyclical component, right? So it's mm-hmm. less surprising to see that part of technology move on a day like today. I think you hit the nail on the head, that it is the fact that interest rates are behaving relatively well that allows some of the more long duration securities to perform well as in addition to that, right? Because when you start thinking about some of those technology growth businesses with a lot of the cash flows far out in the future, they have some bond-like properties, and they can get hurt when interest rates rise.
Giorgio, the last time we talked, we were discussing thinking outside the bond, how to structure a portfolio in an environment where yields are trending higher. After what we've seen the last month, yields calming amid some of the best data we have seen possibly ever, really. I mean, just incredible soaring numbers, new home sales that really are only paralleled by by housing bubble froth. When you see the market calm during these incredible economic data, do you still think that yields trend higher? Do we still need to think outside the bond, or is the market telling us, hey, the Fed's got this thing under control?
So the short answer is I think we still do.
Okay.
Right? And the risks are potentially still skewed to the upside. We had a huge move in the kind of later portions of last year, earlier portions of this year. And it makes a lot of sense for the interest rate market to consolidate. You point out that there have been periods when we've had amazing data like today, and you haven't seen that kind of reaction. We have had just a very strong prelude to this. So I think that's fair, and that all makes sense. As we look forward, so this gets back to that point about the markets listening to the Fed. The Fed has told us that they want a recovery that is broad-based, that is inclusive throughout society. And it's not just about headline employment numbers. And so they are telling us that they are going to run the economy hotter than we might think. And so, we'll continue to see data, but we have to look, we have to go kind of levels beyond just the headline data to really see how that is trickling through the economy. And I think that does set up a scenario where rates could push higher as the market perhaps in this case starts to realize that the Fed might be serious. And then we haven't even talked about infrastructure and green spending.
And we've seen some steps towards that this week. The tax headline may be connected with that next round of spending. Giorgio, next week, though, we know that we're going to have messaging from the Fed. We've got the FOMC. Should we now be kind of wary around that event, to your point about the risk for yields being to the upside, when generally Powell has not been a great pacifier of the bond market as of late? Now that yields have calmed down, are they primed to react?
Yeah, he's been very much on message, just in terms of not being too concerned about interest rates rising, having them rise for the right reasons, and also just very focused on, waiting to see the data, right? And so I think that's where we could see some in really the months and quarters ahead. That's where we could see perhaps the next move up in bond yields, as what is clearly a very robust economy, as we do kind of consistently get hit with very, very positive data. And frankly, real yields are still very low, right? Real yields today are not where they should be in a very healthy economy.